Welcome back to the Deep Dive, the place where we synthesize complex history
Yeah.
and, well, economic chaos into clear, actionable knowledge.
And today we've got a big one.
We certainly do. We are strapping in for a turbulent ride back to the turn of the millennium. We're talking about a period defined by this unprecedented mix of technological optimism, irrational spending, and then a catastrophic financial collapse.
Known simply as the Dotcom Bubble.
Exactly. And we really have to start with the sheer drama of the numbers because they just set the scale for this mania perfectly.
They really do.
So if you were investing in technology between, say, 1995 and the early spring of 2000, you were basically riding a rocket ship. The NASDAQ Composite Index, the primary home for all those tech stocks, it spiked by an astronomical 600% during that period.
600%. It's a number that's almost hard to comprehend.
It's not just growth. That's a fever state. It was all driven by this belief that the internet was fundamentally restructuring everything, all commerce, all human endeavor.
And, as you said, that 600% gain is really only half the story. The violence of the collapse that came after. That's what truly defines the era.
That's where the lessons are.
That's where the painful lessons are, yes. So from its peak on Friday, March 10th, 2000, the index then fell 78% by October of 2002.
78%.
Just imagine watching 5 years of these explosive, historic gains, the kind of gains that had people literally quitting their jobs to day trade,
Right.
completely erased, and then some, all in just 2.5 years. The loss in market capitalization was just staggering. The financial devastation was swift, and for many, it was absolute.
It's so easy to look back now and just dismiss the whole thing, to see it as this one-off moment of collective insanity that was fueled by, pizza delivery startups and talking sock puppets.
Yeah, the Pets.com sock puppet.
Exactly. But you pointed out something really crucial when we were prepping for this. While the scale and the technology felt completely new, the underlying phenomenon, this boom and bust cycle, it's actually ancient history, isn't it?
It really is. The dot-com boom was just the information age's version of a pattern that repeats and repeats throughout history. It's always triggered when a truly transformative technology arrives on the scene.
So like the railroads?
You see the exact same dynamics with the railway mania back in the 1840s, the explosive growth of radio in the 1920s, or even the speculative frenzy around biotechnology in the 1980s.
Okay.
The sequence is always the same. You get this genuine technological innovation that sparks immense, justifiable excitement, but the initial enthusiasm and, crucially, the available capital, it far outruns the practical ability of these new companies to actually monetize the technology.
Where profits become secondary.
Completely secondary. They become an afterthought to potential.
And that disconnect, the potential versus the actual profit, that is the core tension we're going to unpack today for you. We're going to synthesize the economic conditions that created the environment, the specific cultural symptoms of the madness, the shocking way that collapse unfolded, and maybe most importantly, what surprising essential infrastructure was ultimately left behind after all the dust settled.
Right.
We're looking at why it felt so inevitable at the time and what lessons we can maybe apply to today's markets.
Okay, let's unpack this.
Let's do it.
So, to understand the irrationality, I think we first have to ground ourselves in the genuine, rational excitement of the time. This bubble wasn't built on nothing, right? It was built on a monumental shift in how people accessed information and commerce.
That's absolutely right. The internet had been around for decades, of course, but mainly as a research and government tool.
Right, ARPANET and all that.
Exactly. But its popularization, the moment it became a mass consumer product, that came with the release of the Mosaic web browser in 1993.
And then Netscape Navigator right after. And suddenly, the World Wide Web became graphic, navigable. It was accessible to anyone with a personal computer. That was the real point of no return.
And the data shows just how quickly this translated into consumer behavior. I mean, this is a true shift to the information age. Over a very short 7-year span, between 1990 and 1997, U.S. household computer ownership more than doubled. It jumped from about 15% to 35%.
And that transition was so critical, it meant that a computer was no longer some specialized machine for work or for hobbyists.
Yeah, it was becoming a household necessity.
It was. And that created this enormous, eager market for new online services, for software, for e-commerce platforms.
And to facilitate this massive new market, you needed fuel. You needed financial fuel.
And the macroeconomic environment was incredibly accommodating. Throughout 98 and 99, the Federal Reserve, led by Alan Greenspan at the time, kept interest rates unusually low.
Which made money cheap.
It created a profound sense of liquidity. Capital was just readily available, and extremely cheap for any startup that promised to harness the power of the internet.
And the government wasn't just fueling it with cheap money either. They were also incentivizing risk-taking through tax policy.
Yes, the Taxpayer Relief Act of 1997. It lowered the top marginal capital gains tax rate in the U.S.
And that small change had a massive psychological impact, didn't it? It encouraged all this speculative investment.
It really did. Investors looked at the potential for a massive quick return, and they thought, well, even if this company triples in 6 months, the tax hit won't be that bad, so the risk is worth taking.
It essentially rewarded short-term gambling.
In a way, yes. And we also cannot overlook the significant regulatory stimulus that came from the Telecommunications Act of 1996.
Okay, tell us about that.
Well, this legislation was intended to foster competition by deregulating huge segments of the telecom industry. So the collective expectation among both investors and regulators was that this act would just unleash an explosion of new infrastructure, new providers, and entirely new technologies.
But everyone rushed to get in on the ground floor.
People rushed to invest early. They were trying to stake a claim in what they perceived would be the next industrial revolution.
So, okay, we've got the tech foundation, we have mass market adoption, and we have cheap capital. And that brings us to the core business driver that rationalized those early, very high valuations. You called it the killer app idea. That's the vision. The World Wide Web was seen as the ultimate killer app, precisely because it promised something that had previously been technologically impossible: disintermediation, cutting out the middleman.
Exactly. It promised to bring unrelated buyers and sellers together in this virtual, seamless environment, instantly and cheaply. If you could cut out that whole distribution chain, wholesalers, retailers, expensive print advertising, you could achieve unimaginable margins and just completely overturn decades of established business dogma.
It sounds like the core thesis was built on an assumption of, well, non-competition. Like, they weren't just disrupting the incumbents. They were assuming the incumbents wouldn't even fight back.
And that's the tragic flaw in so many of those early dot-com business plans. They were all predicated on this notion that if they simply built a website and acquired eyeballs, as they called it,
Right.
they wouldn't have to compete directly with the traditional giants. Entrepreneurs believed their speed and their digital agility would be enough to just leapfrog the established players.
So, for example, why would Amazon need a massive warehouse network when they could just connect sellers to buyers directly?
Or why would Pets.com need to compete with local pet stores when they offered convenience right to your door?
But that hope, as history proved pretty brutally, was completely shattered.
It was, because the established businesses, the traditional retailers, the media companies, the distributors, they possessed two critical things the startups lacked.
Okay, what were they?
Incredibly strong, recognized brands that were built up over decades and deep existing cash flows.
Right.
So once these giants realized the threat, they simply used their existing resources to develop their own robust internet presences. And the newcomers, who thought they were playing a totally different game, suddenly found themselves in direct head-to-head competition with these financially impregnable Goliaths.
And they couldn't afford to outspend or outlast them, which meant their entire model of rapid growth without any profit was doomed.
It was doomed from the start.
This leads us beautifully from the rational excitement of the internet's potential right into the fully irrational euphoria of the bubble's peak.
Yeah.
The financial culture went from, let's say, risk-taking to just reckless gambling.
The whole atmosphere shifted. By 1999, the mantra among venture capitalists, VCs, and investors was, at any valuation.
At any valuation.
Yeah, if your pitch deck had a .com suffix on it, money was poured in. VC funding became astonishingly easy to secure, and that led to this flood of capital managed by entrepreneurs who were, often brilliant at technology, but utterly inexperienced in prudent business management.
And the key symptom of this irrationality, as you noted, was the complete abandonment of traditional financial metrics. We're talking about things like the price-earnings ratio, or PE.
Yes. The PE ratio, which measures the cost of a stock relative to the company's actual earnings, became a quaint idea, as the Wall Street Journal memorably suggested.
A quaint idea. Wow.
Yeah. So when the NASDAQ Composite peaked in March 2000, its PE ratio hit a surreal 200.
200. Can you put that in context for us?
Sure. So the Japanese asset price bubble in the early 90s, which was kind of the previous high watermark for speculative excess, saw the Nikkei 225 peak at a PE of around 80.
80. Okay.
Dot-com valuations were more than double that historical extreme. Investors were basing their confidence entirely on abstract concepts like future potential, technological dominance, mind share.
All completely divorced from whether the company was actually making any money.
Exactly. Instead of earnings, the new metric became eyeballs. How many people visited your site? How much mind share did you own?
Because the idea was built around network effects, right?
That's the crucial concept. The belief was that the value of the platform or the service increased exponentially with each new user. The first user gets little value, but the millionth user makes the system exponentially more valuable for everyone.
So the priority became scale.
Scale at any cost. You had to capture those network effects before a competitor did. If you had to lose $100 on every single transaction just to gain a customer, that was considered an investment in the network. It wasn't a loss.
And this leads us to the role of the investment banks, who were, well, they weren't just passive observers in all this.
Not at all. They were actively fueling the speculation because they had massive incentives to keep the boom going.
The incentives were direct and enormous. Investment banks made huge profits from initial public offerings, IPOs.
Right. So when a dot-com went public, the banks charged substantial fees for underwriting those deals. So the more companies that went public, the more money the banks made. They were incentivized to encourage investment in bullish coverage from their analyst departments, regardless of the underlying financial health.
Which is a massive conflict of interest.
A huge conflict of interest. Was the bank serving the investor or the company it was taking public?
And the results were just euphoric. That 400% rise in the NASDAQ translated into legendary gains. We hear about the giants, but the volatility itself was thrilling.
In 1999 alone, Qualcomm shares, a major player, rose an astronomical 2,619%.
2,600% in 1 year.
And that wasn't an outlier in the large cap space. 12 other stocks with significant market caps each rose over 1,000% that same year. People saw their neighbors, their friends, and themselves making massive paper wealth overnight.
And that creates a cultural feedback loop.
It does. The media amplified this sense of inevitability and urgency. You had the Wall Street Journal, as we said, suggesting investors rethink the quaint idea of profits. It implied that anyone who focused on current earnings just didn't get the new economy.
And CNBC, which was on in every office, every home, it treated the stock market like a continuous sporting event. It was high drama, high stakes reporting that just normalized the idea that everyone should be participating in this massive wealth-generating spectacle.
And this directly contributed to the cultural symptoms of personal investing. The stories were just. They were ubiquitous. You heard about people quitting their secure jobs, accountants, teachers, retirees, to become full-time day traders.
Right. They thought they could just ride the daily surges and become millionaires.
They believed the market was a sure thing, a guaranteed path to riches that required only access and nerve, not necessarily expertise or financial prudence. And this is where we get to that core operational philosophy: growth over profits, or, as they said, get big fast and get large or get lost. The entire philosophy rested on the idea that profitability would come later once market dominance was secured through mindshare.
So companies willingly operated at massive net losses. They just spent their venture capital and IPO funds lavishly to achieve that scale.
They offered services or products for free or at steep discounts, trying to buy market share and lock in those network effects. And the most visual sign of this philosophy was the spending culture.
Tell us more about the lavishness, because the stories are legendary.
The money was often spent with a staggering lack of oversight. I mean, companies poured millions into these elaborate, high-tech business facilities. You know, the classic Silicon Valley startup with endless free snacks and high-end aesthetics. There were extravagant luxury vacations for employees, a way to reward success even when the company wasn't actually turning a dime.
And then the infamous dot-com parties.
Oh, the parties.
Yeah.
For product launches. They were expensive, over-the-top events. It symbolized this absolute invincibility complex that permeated the era. I mean, why worry about a burn rate when money was literally free?
The burn rate, that's the key metric here, isn't it? The rate at which a company just spent through its cash reserves.
It became everything later on.
And the sheer amount of money burned on promotion is best exemplified by the Super Bowl.
It's the perfect cultural snapshot. In 2000, for Super Bowl XX4, 17 different dot-com companies bought highly visible advertising spots.
17.
Think about that. 17 companies, many of which had never made a single cent in profit, spent between $1.9 and $2.2 million for a single 30-second commercial. That total expenditure, over $30 million just on a half minute of TV time, was proof that spending to gain brand awareness trumped all common sense. Just 1 year earlier, only 2 dot-coms had advertised during the game.
So that spike shows the bubble at its absolute zenith.
Just weeks before it peaked and then violently burst.
We focused a lot on the e-commerce and the software firms, the pets.coms and the web vans. But the speculative fire wasn't just confined to those consumer-facing sites.
No, not at all.
Running parallel to this dot-com mania was a massive, and I think equally irrational, boom and bust in the telecommunications sector. This was the physical infrastructure that was supposed to make the whole internet dream possible.
It's absolutely vital that we recognize this. The dot-com boom was supported by the telecom boom. They were two sides of the same coin.
Okay.
In the 5 years following the deregulation spurred by that 1996 Telecommunications Act, telecom equipment companies invested over $500 billion into infrastructure.
$500 billion.
An astonishing amount of capital poured into laying fiber optic cable, adding switching centers, and building out wireless networks.
And this was financed primarily through debt, correct? It wasn't organic growth. It was a massive borrowed bet on infinite future demand.
Precisely. The vast majority of that $500 billion was debt financed. Companies like Global Crossing and WorldCom borrowed relentlessly. They anticipated that the data traffic from the dot-com sector would grow fast enough to fill all that new capacity almost immediately.
And local governments were often partners in this expansion, weren't they? They thought they were creating these high-tech job hubs.
Absolutely. You can look at the Dulles Technology Corridor in Northern Virginia, for example. Local and state governments heavily encouraged and even funded infrastructure projects. They created favorable business and tax laws to attract these massive data centers and fiber cable installations.
So the whole region was betting big.
They were betting big on the idea that they would become the epicenter of this new digital economy.
But the core problem, just like we saw with the dot-coms, was that the growth in capacity, it vastly outpaced the actual growth in demand.
It created what we call a massive overcapacity problem. Companies laid immense amounts of fiber optic cable, often referred to as dark fiber.
Meaning cable that was laid but not yet active or even needed.
Exactly. The demand for bandwidth simply wasn't rising fast enough to utilize the sheer physical volume they installed. They basically built 10-lane digital highways when only 2 lanes were needed, all based on projections that turned out to be wildly optimistic.
And then we had the purely speculative madness of the 3G spectrum auctions. This was pure speculation, right? Driven by governments trying to cash in on the fervor.
These auctions were financial insanity. Governments were selling the rights to use parts of the radio spectrum for what would become 3G mobile services. The bidding was so aggressive and so speculative that it resulted in truly mind-boggling expenditures.
Like in the UK.
The UK auction in April 2000 raised £22.5 billion. Just months later, the German auction raised a staggering £30 billion. Companies essentially paid fortunes for licenses to use technology that was still nascent and lacked proven business models, simply because they were terrified of being left behind.
The US auction, though, that serves as the perfect historical warning sign.
It really does. In 1999, the U.S. had a 3G spectrum auction that had to be rerun because the initial winning bidders defaulted on $4 billion worth of bids. They just couldn't raise the capital.
We couldn't pay.
So when the U.S. government re-auctioned those same rights, they netted only 10% of the original sales price. This demonstrated, in hard numbers, the sudden and brutal collapse in the perceived value of future telecom rights.
So when the financing finally dried up, the heavily debt-financed nature of these telecom companies, it proved fatal.
The crash was spectacular. When the high-flying dot-coms stopped ordering services and infrastructure and the capital markets slammed shut, those high debt ratios became impossible to service.
And that led to a rash of iconic bankruptcies.
Yes, including WorldCom, which was at the time the largest corporate bankruptcy in U.S. history. And the bond investors, the people who actually loaned these companies at $500 billion, they recovered, on average, just 20% of their investments.
A staggering destruction of capital.
It was.
But here's the profound irony that connects this massive failure to our current reality. That $500 billion in lost debt-fueled investment wasn't completely wasted, was it?
Not at all. And this is the crucial takeaway from the telecom bubble. That excessive debt-fueled expansion, that massive overcapacity, is the very reason why high-speed internet connectivity, fiber optics, and robust networks became so affordable and ubiquitous today.
So the companies went bankrupt.
But the physical infrastructure, the cable in the ground, the switches, the data centers, it all remained. The next wave of technology companies, your Googles and your Netflixes, were able to step into a world where high-throughput connectivity was essentially a commodity.
Paid for by the investors who lost billions during the bubble.
Exactly. The failure of the boom delivered the vital high-speed backbone for the modern internet.
So the crash wasn't a single event. It was more like a slow, painful execution stretched over 2 years, starting in the spring of 2000. But before that major collapse, we had one final piece of volatility, the anticipation of the year 2000 problem, or Y2K.
Well, Y2K, that was an immense preoccupation leading up to the new millennium, wasn't it? Companies spent fortunes on technology upgrades out of fear that when computer clocks flipped from 99 to 0, core systems would just fail.
But nothing happened. Well, the preparation was adequate, and virtually no major disruption occurred. So once the world realized the system hadn't crashed, attention immediately shifted back to the only problem that actually mattered: grossly inflated stock valuations. And the clock was ticking down. The specific peak was Friday, March 10, 2000. The NASDAQ U Composite closed at 5,048.62, and the index has never seen that height again.
The crack started showing almost immediately. Just 3 days later, on March 13th, news that Japan had formally entered a recession triggered an immediate global sell-off. And since tech stocks were by far the most inflated globally, they took the brunt of that flight to safety.
Then, a really crucial sign of investor fear emerged on March 15th. Yahoo and eBay, two of the biggest online players, officially ended their merger talks.
Right. The NASDAQ fell 2.6% that day, but here's the signal. The S&P 500, which holds more of the established non-tech firms, it rose 2.4%. And that divergence proved that investors were performing a massive, visible rotation of capital. They were getting out of highly volatile tech and into established companies. The smart money was quietly leaving the party.
We also have to talk about the role of the Federal Reserve Chairman Alan Greenspan. He had raised interest rates multiple times during the bubble, but critics, like the economist Paul Krugman, argue strongly that he waited until the bubble had already burst. So if he waited too long, wasn't the market interpreting the Fed's inaction as a kind of tacit endorsement of the boom, which just fueled the irrationality even more?
That's the core tension, and it's a very good point. Many felt that the Fed was engaging in a form of asymmetric intervention, that the market expected the Fed to step in and save them if the crash was too painful, what they called the Greenspan prit.
Right.
But that the Fed was hesitant to curb the speculative enthusiasm on the way up, fearing they might stifle innovation.
So Krugman's critique was that Greenspan was just trying to clean up the mess afterwards.
Exactly. Rather than proactively using tools like, say, higher margin requirements to prevent the excess in the first place.
The tipping point in sentiment was definitively reached on March 20, 2000. The media, which had once celebrated the mania, really started to ring the alarm. Yes, Barron's published a devastating cover story. The title was, "Burning Up, Warning, Internet Companies Are Running Out of Cash Fast." And on the very day that article hit the newsstands, that warning was terrifyingly illustrated by a major accounting scandal.
MicroStrategy, a high-flying tech firm whose stock had exploded from $7 to $333 per share in a year.
Unbelievable.
On March 20th, they announced a revenue restatement due to aggressive, inflated accounting practices. Their stock plummeted 62% in a single day, down to $140.
And that proved to investors that the numbers were fabricated. The faith based on potential just evaporated.
Instantly. Then, regulatory scrutiny and fear compounded the problem. On April 3, 2000, Judge Thomas Penfield Jackson ruled that Microsoft was guilty of monopolization and tying.
And that sent shockwaves through the whole tech sector.
It did. Microsoft's stock dropped 15%. The NASDAQ fell 8%. The market feared that this ruling signaled a new era of aggressive regulatory intervention, which was bad for all high-growth tech firms, even those not directly involved. It introduced this element of political risk that investors hadn't really accounted for, and that day marked a complete cultural reversal. The sentiment was perfectly captured by a widely read article from Bloomberg News, which delivered the solemn decree. It's time at last to pay attention to the numbers. The party was officially over. The final definitive crash moment came on Friday, April 14, 2000, what became known as the tech wreck.
Right.
The NASDAQ composite fell 9% in a single day, closing out a week where it lost 25% of its entire value.
And this was made worse by a very specific technical factor, right?
Yes, it was tax day. Investors had to sell their high-flying stocks to raise cash to cover the massive capital gains tax bills that were due for the gains they'd realized in the previous year. So they were forced sellers at the worst possible time, which just intensified the panic.
From there, the decline accelerated and the most iconic failures started to roll in. Pets.com, which had burned through millions on its Super Bowl ad, became the national symbol of failure. It went out of business on November 9, 2000, less than 9 months after its IPO.
And the pain was prolonged and deepened by external factors. The September 11th attacks in 2001 accelerated the overall drop, adding geopolitical risk to the financial uncertainty.
And then came the wave of major corporate accounting scandals.
Enron in 2001, then the WorldCom and Adelphia debacles in 2002. They just completely eroded any remaining investor confidence. When you realize the foundation of the economy is built on criminal fraud, you stop trusting any aggressive valuation.
And the market finally bottomed out almost 3 years after it peaked.
Yes, the market reached its trough on October 9, 2002. By that point, the entire market had lost $5 trillion in market capitalization since the peak. The Nasdaq Q100 index had plummeted 78% from its highest point. The financial reckoning was complete.
So the money was gone, the exuberance was crushed, the bubble had burst. How did the corporate mentality change overnight from get big fast to how do we survive until Friday?
The shift was immediate, and it was brutal. The focus flipped entirely. When the venture capital dried up, a company's lifespan was no longer determined by its potential market dominance, but by its burn rate.
The rate at which it was spending its existing cash.
Right. If you were spending $5 million a month and only had $10 million in the bank, you had 2 months to live. That metric became everything.
And we saw the human and cultural cost immediately in the massive layoffs.
A staggering number of layoffs. This created a huge glut in the job market for programmers, for web developers, for tech specialists. The promise of instant wealth vanished, replaced by instability. And we saw a noticeable and measurable drop in university enrollment for computer-related degrees because the perceived value of that career path just plummeted.
And the liquidation of these companies produced some of the most enduring cultural symbols of the excess, all these status symbols being sold for pennies on the dollar. The Aaron Chair anecdote is just perfect for this.
It really captures the sudden, painful end of that culture of excess. The Aaron Chair was the ultimate status symbol in the dot-com world. It was expensive, ergonomic, retailed for over $1,100 each.
It signaled that you worked at a successful, well-funded startup.
Exactly. When the company shut down, these chairs, along with high-end server racks and lavish office furniture, were liquidated en masse at fire sale prices. Walking into a liquidation sale and seeing thousands of those chairs stacked up was just. It was a powerful, tangible metaphor for the sudden, undignified death of the boom.
Beyond the operational changes, there was a major push for accountability, right? Driven by the massive scope of the criminal fraud that was exposed in the wake of the crash.
Indeed. The failure of WorldCom and Enron led to criminal prosecutions for executives like Bernard Ebbers, Jeffrey Skilling, and Kenneth Lay. They were convicted or accused of fraud for misusing billions of shareholders' money.
And regulators stepped up.
They did. The U.S. Securities and Exchange Commission levied large fines against prominent investment firms, including Citigroup and Merrill Lynch, for conflicts of interest specifically, for misleading investors with those bullish analyst reports while simultaneously charging the company massive underwriting fees.
And for the retail investor, the person who had been day trading and fueling this mania, what was the lasting psychological impact?
A profound shift toward caution. The retail investor transitioned to much more conservative, cautious investment portfolios after suffering such catastrophic losses. The highly focused internet forums that had been the heartbeat of the speculative mania sites like Silicon Investor and the early Yahoo, finance boards, they saw a significant and permanent decline in use. The excitement of the gamble was replaced by the sting of reality.
But as we wrap up, we have to address the beautiful irony here. While hundreds of companies failed, the crash was actually a cleansing Darwinian event that benefited the survivors.
It was Darwinian economics at its absolute finest. Despite the spectacular failures of rivals like Webvan and Pets.com, 48% of dot-com companies actually managed to survive through 2004, albeit at dramatically reduced valuations.
And the vacuum left by the bankrupt competitors.
It allowed companies with fundamentally sound business models, companies that eventually figured out things like inventory control, strategic pricing, actual revenue streams, to gain overwhelming market share.
And who were those survivors that went on to dominate?
Well, Amazon and eBay are the classic examples. They had to endure massive drops in valuation, but they had tangible business models and a core mission. Amazon, despite its early struggles, was ruthlessly focused on customer experience and distribution efficiency. eBay provided a unique, scalable marketplace.
And new giants emerged from the ashes.
Exactly. Firms like Google and NVIDIA used the massive amounts of cheap infrastructure and the lessened competition to build the modern digital empires we know today.
So the fundamental positive legacy of all that irrational lost capital is the infrastructure itself. It is the infrastructure, and that is a lesson we shouldn't forget. I look to the words of venture capitalist Fred Wilson. He funded many dot-coms and lost 90% of his net worth in the process. He famously concluded, "Nothing important has ever been built without irrational exuberance." That's a powerful statement because it accepts massive loss as a necessary cost of innovation.
Yeah.
So if we rely on irrational exuberance to build infrastructure, are we essentially accepting future painful financial reckonings as just part of the process? We are, if we don't manage that exuberance.
Right.
The mania financed something crucial, that massive high-throughput backbone for the internet, along with the essential databases, software, and server structure that now underpins the global economy. All the excessive debt-fueled spending that bankrupted thousands of firms nevertheless left behind the physical foundation that allowed the modern trillion-dollar tech economy to flourish. So the dot-com bubble was a spectacular financial failure
That produced the greatest technological success in human history.
We've covered the 600% spike, the violent 78% drop, the Super Bowl ads, the errand chairs, and the essential hidden infrastructure that the mania left behind. It was chaotic, painful, and ultimately transformative.
And that reveals the dual nature of these speculative cycles and why we study them. We established that the dot-com bubble was fueled entirely by faith in technological advancement, which caused investors to completely ignore traditional financial metrics like current profits. Today, just 2 decades later, the most valuable public companies in the world are almost exclusively in that same technology sector, and many are still valued heavily on future potential rather than immediate earnings.
So that raises a crucial question for you, the listener.
Are the factors that fueled the original dot-com bubble, the raw enthusiasm, the focus on novelty, the expectation of infinite growth, the sheer joy of discovery, are they still present in the markets today? Or did we, as a collective financial system, truly learn the ultimate lesson from the early 2000s to pay attention to the numbers?
A phenomenal way to leave it hanging. Thank you for joining us on this deep dive into the mania, the money, and the making of the modern web.